Hey everyone, it is Friday afternoon and we are closing in on the end of another week. I just wanted to talk to you guys about the overall opportunity in the stock market right now. One of the most frequent questions that I get asked is this a good time to invest in stocks or not? And as an individual dividend investor, you're buying individual companies. So there's always an opportunity somewhere in the market if you can identify it. However, it's also important that you identify kind of where we're at in the overall market cycle. That can really help you increase your future returns through time and help you avoid losses, pretty significant losses, if you can kind of identify more of the peaks or what conditions lead to the peaks. So today I want to give you three different data points for what can signal those different market extremes. Now, one thing I do want to say here is that this is not a necessarily something I think you should look at as a timing mechanism or trying to, get in and out of stocks at perfect times. All you're trying to do is identify, is the overall general conditions of the market right now extremely positive, extremely negative, or somewhere in between. I don't think it's always healthy for investors to, try to say, well, stocks are going to go up 7.4% next year. That trying to get that precise, I think, is A, impossible, but B, it's not really that productive. All we really care about is more of the extremes, and I think that's where you might make some modifications to your strategy. But for the most part, in most environments, just dollar cost averaging and just kind of staying on some kind of predetermined investment plan, I think is the most optimal solution for 90% of the environments that we're in. It's just those extremes that you're trying to identify. So I'm going to show you guys these three data points. I think these will be really helpful for you guys in just keeping an eye on where things are at. They're quantitative, so it's not my opinion, it's just what are the numbers saying. And I think that's really helpful when you're trying to avoid making psychological mistakes. So this first chart, before I get to the data, this is kind of the danger of spending too much time out of the market. So I think the default answer to should I buy or should I wait is always buy. The default answer should always be buy, unless the burden of proof is to selling or waiting. So this explains why this chart, going back to 1802, a $1 investment in the stock market has grown to over $1.1 million. You can see bonds, the treasury bonds grew to $1,649, treasury bills at $268, and here's gold. $1 in 1802 is now worth $2.97, and then sitting in cash obviously results in a pretty bad outcome. $1 in 1802 has the spending power of 5 cents. So in general, if you don't know what to do, stocks are almost always the way to go. If you constantly are waiting for the next market crash, you don't know whether that could be 100% from now, right? The market could double and then you get a 50% crash, but by that point you would have been better off to invest at the very beginning. So there's always an opportunity cost when you're not in stocks, and I think your default should always be to, like I said, dollar cost average or remain in the market unless certain signs suggest otherwise. So now back to the data. First bit of data I think is really interesting here, and this is mostly for identifying major buying opportunities. So if you have a lot of cash sitting around, this is something that I would look at. This is the insider buy-sell ratio going back to January of 2004. So you can see that anytime, so this blue bar represents the number of insiders, so corporate CEOs, CFOs that are buying stocks, divided by the number of corporate insiders that are selling stocks. So generally speaking, this ratio is below 1. There's a lot of reasons why insiders would sell. You got to pay for college, you got to just do life, right? They're raising money by selling the stock that they own in their companies. There's only one reason to buy, and that is you think the stock is going up. So in aggregate, when you have a lot of corporate insiders all deciding to buy their own stocks, it gives you a good signal that a lot of CEOs, who are the ones that know their companies the best, they believe their particular stock is undervalued. So if you get a lot of those CEOs thinking the same thing, it can indicate that stocks are a good buy. So this ratio getting above 1 has historically been a really good opportunity to be buying stocks. So here is the 1 ratio. You can see this crossed above 1 in September of 2008. Right here, the red line is where stocks, the S&P 500, were trading at that point in time. So you can see this huge spike in insider buying signaled, in general, a pretty good time to buy stocks. It was not perfect. Obviously, this was a little early. The market continued to decline. But again, we're not trying to identify what's the perfect buying opportunity. We're just trying to identify, is this in general a good buying opportunity or not? So this is a good signal. Again, it happened in September of 2011. We had another spike above 1 for 2 months. And that was, again, a good time to buy stocks. Happened again in May of 16 for just 1 month. Again, good time to buy stocks right there. Happened again at the end of 2018. So you may remember that market collapse, didn't collapse, fell about 20%, almost 20% top to bottom. That was a good time to buy. You had an insider ratio above 1 for 2 out of those 3 months. And then, interestingly enough, last month, March, again, the insider buy-sell ratio exceeded 1. We don't know if that's actually a good buying opportunity. It appears at this point that it was. So we don't know if this will go lower than that eventually. But for now, it appears to be, again, a very good signal. Right this very second, the latest data is around the 0.5, which is more of a normal environment. So this is neutral. It's not suggesting that insiders are scrambling to buy. So that, to me, is not an overly optimistic indication. The second data point are valuations. So the valuations are critical when you're deciding whether or not to buy or sell any investment, whether it's stock or real estate, anything. Valuations are absolutely important and essential. This is a model that I put together using a longer-term average earnings. It uses average earnings and then also interest rates. So whenever average earnings continue to go up, up, and up, and up, the value of the stock market will also continue to go up in general. The same thing happens when interest rates go down. So like today, interest rates are extremely low, which means the competition for stocks is also low. So that means that generally speaking, the value of stocks should increase as interest rates go down. So this model looks at both of those factors and tries to arrive at a reasonable fair value estimate for the S&P 500. So using the current inputs of this model, the fair value of the S&P 500 is somewhere around 2,800. 2,840 is the exact number that I came up with, which is about where we're trading at today. And then in 68% of cases, or plus or minus 1 standard deviation, I would expect the S&P to go between 2,100 being a very good buying opportunity, and then 3,570, being maybe more of a time to sell. So that's valuations. Again, we're right about at the midpoint fair value at this point. So I would say this is, again, neutral. And then the third point, this is the fear versus greed index. CNBC publishes this, and you can see that whenever investors are extremely fearful, that has generally been a good opportunity to buy stocks. Warren Buffett famously said, "We want to be fearful when others are greedy, and greedy when others are fearful." So this is again a quantitative way for you to say, how are investors feeling? If investors are feeling greedy, so whenever this metric gets above, say, 80, this line here is considered a pretty greedy environment, which means stocks are probably priced for perfection, so to speak, or they're trading above. Investors are getting really optimistic about conditions. Probably a good time to think about, selling, if other conditions line up. And then when you get to the other end, the extreme fear side, that suggests that a lot of the fear is already baked into stock prices, and they may be a good opportunity to be buying. And generally, when this fear greed has turned to extreme fear, that's been a good indicator that stocks are probably starting to bottom out, and it's a good time to buy. So right now, this is more fearful, so it's on the lower end of 50. So it's more fearful than greedy, which is a slight positive for the market, but it's close enough to kind of this middle ground that I went ahead and marked this as neutral. So taking this, kind of putting this all together, I would personally, my feeling for the market right now is it's neither a great time to buy, nor is it a great time to sell. I mean, it's probably kind of more of a neutral environment. If, like I said, if in this situation, I would probably just continue with your long-term investment plan. If you're way overweight stocks compared to where you want to be, might be a good time to rebalance and get back to a different weighting. But other than that, if you're just adding money to the market for retirement, you're just starting out. I think 25 years from now, you're going to look back at this, and it's more important that you start investing than just to continually sit on the sideline and wait for the best opportunity. There are some opportunities that are better than others, but at this point in time, it just kind of looks pretty neutral to me. So I would encourage you just to continue on with your plan, continue adding to stocks in a systematic way, and then if we start to see some of these indicators start to get worrisome, maybe that's a time for you to, hold a little bit extra cash or something like that to maybe invest for more opportunistic prices. But anyways, I will update this. I'm trying to update this once a month, once every couple months. So if you want to get notifications when that comes out, hit the subscribe button down below. I'll put a little box in the bottom right of your screen. Just click that, hit the subscribe, turn the bell on. Also, if you like this video, hit the like button. That would really help me out. I'd really appreciate that. Helps my channel quite a bit. So really would appreciate that. Appreciate you guys subscribing, and appreciate you watching this video. So I hope this was helpful for you guys, and have a great rest of your weekend. Talk to you guys later.